It is. It's 12 o'clock now, so we'll go ahead and get started. Thank you, everybody, for joining us today. We're excited to be having this webinar for you guys. I'm going to turn it over to Tom Lillard, and he'll get us started. If you guys have questions, feel free to type them in the chat box, or we can follow up with you after the webinar for some more specific questions. So, Tom?
Okay, thanks, Frank. Hello, I'm Tom Lillard. I do know probably many of you on the screen. If you don't know me, I'm a 1979 graduate, proud graduate, as is my wife and 3 kids. My duties at Radford, I oversee the major gift officers as well as overseeing our planned giving program. At Radford, planned giving began in 1988 as a society in 1910, and I'm proud to report now we're up to about 250 members who have shared with us that we're in their estate plans. A little bit about today's program. I'm proud to share that Radford University Foundation recently has partnered with BNY Mellon to manage our investment assets, as well as provide a wide range of financial expertise. Today, we're really fortunate to be joined by a true industry expert, Jerry Doyle from BNY Mellon. Jerry is the Senior Vice President and is an estate planning strategist. Jerry will present an overview of planned giving arena and possible things to consider in this interesting 2020 year. So at this time, it's my pleasure to introduce Jerry. And Jerry, thank you very much for joining us.
Thanks, Frank, and welcome, everybody. Good afternoon. What we're going to do today is we're going to go just through an overview. The slides that I have may have a few things that are a little bit more complicated, but I'm going to give you a little overview of planned giving and the things that you ought to look out for. If you have any questions, feel free to email me. My email is jere.doyle@bnymellon.com. I should have put it on the screen. It usually is, but I just noticed it's not there. So what we're going to do is begin by talking about the types and timing of charitable gifts. The Internal Revenue Code has a number of different code sections that deal with charitable gifts. One of the code sections of what we'll be focusing on is gifts during lifetime. There are certain rules for gifts that are made during lifetime. There are other rules for gifts that are left in your estate to a charitable organization. And finally, there are a separate set of rules if you have a trust or an estate to get an income tax charitable deduction from that particular entity. We're not going to focus on the estate tax gifts or on the gifts from trust and estates. What we're going to focus on is lifetime giving. And that gets us to this slide. If somebody wants to get an income tax charitable deduction for the amount that they give to a charitable organization, what they have to be concerned with is how much can they deduct? Can they deduct the fair market value of an asset that they give to charity, assuming they're making a gift of, say, real estate or stock versus cash? So can they deduct the fair market value or only the cost basis? And that's going to depend. It's going to depend upon the type of property that they give to the charitable organization like Radford. If it's long-term capital gain property and it's given to a public charity, by long-term capital gain property, I mean property that you've held for over a year. If it's long-term capital gain property, you can get a deduction for the fair market value of that property. And we'll see what the limit on that is in just a second. If you give cash, obviously there's no issue with whether the fair market value or the cost basis of the property can be deducted. If the type of property you give is not long-term capital gain, if it's held for less than a year, then you can only deduct your cost basis in that. That is what you paid for it. You can't deduct the fair market value. So you got to be a little careful there. And then the contributions that we make during lifetime for income tax purposes, the amount of the charitable deduction that we can take is going to depend, again, on the type of property that we give. It's a little bit confusing now with cash because traditionally, we have been limited and only able to deduct a charitable contribution up to 50% of our adjusted gross income. And that's basically line 8B on your Form 1040. So there is an upper limit on the amount that you can take for an income tax charitable deduction for a gift that you make during lifetime. And as I said, traditionally with cash, it has been 50%. Well, a couple of years ago, in 2017, they bumped that percentage to 60% of your adjusted gross income. And for the year 2020 only, The government is running a special, at least for the next couple of months, whereby for this year you can deduct up to all of your adjusted gross income, 100%, for gift to a charitable organization. We'll talk about that in just a second. And then finally, the amount that you can deduct is going to depend upon the type of organization you give it to. Generally, if you give it to a public charity like Radford University, the deduction limitations are a lot more favorable than if you give it to a private foundation. These are the percentage limitations. This is a little bit of a chart that you can refer to later on, and I'll just focus on the two most popular types of charitable deduction. That would be cash. If you give cash to Radford, you can deduct, obviously, the denomination of the cash up to this year 100% of your adjusted gross income. Now you'll see on the diagram there that I say 50% of your adjusted gross income or AGI. You notice a little star there. If you look down in the bottom left-hand corner, you'll see that it's 60% of your AGI from 2018 to 2025, except for this year, 2020, you can get an income tax charitable deduction for the entire amount of your adjusted gross income, 100% of your AGI. The other type of property that most people, or an asset that most people would give to charity would be long-term capital gain property, like real estate that's been held for over a year, or stocks that have been held for over a year. Again, if that is given to a public charity, like Radford, you'll be able to deduct your fair market value, but that fair market value will be limited to 30% of your adjusted gross income. So you can see that the limitation on the amount that you can deduct in any particular year is a little bit less for gifts of long-term capital gain property than it is for cash. If you do exceed those limits, you'll see in the bottom line there that any amount that exceeds that 50, 60, or 100% or 30% of adjusted gross income, it can be carried forward for 5 years. After 5 years, if you haven't used it all up, it's gone. It expires. So you've got a little bit of leeway if you contribute more than the amount that is allowed under this diagram here. So our general rule is we can deduct the fair market value if we hold it for more than 1 year of stocks or real estate. But again, the deduction is limited to adjusted gross income. And there's a particular benefit that you'll get if you give appreciated property, like appreciated stock, to a public charity, because as this illustration shows, you're going to be able to deduct not only the fair market value of the item that you give to the public charity, like Radford, you'll also get away without having to pay tax on the capital gain. So quickly, just to go through this illustration, suppose you want to make a gift of $10,000 worth of stock to Radford that you bought for $1,000. So there is an embedded $9,000 capital gain there. Well, if you sold that stock and you're in the maximum income tax bracket, you'd have to pay a 20% capital gains tax on that, which would mean you'd have to pay $1,800 in tax. If you give that appreciated property to Radford, you will get an income tax charitable deduction of $3,700. That's the fair market value of the stock. Plus, you won't have to pay tax on that capital gain, and neither will Radford when they sell it, because they're a tax-exempt organization. So the total tax savings in this example is $5,500, and the cost to you as the donor of that charitable gift is a mere $4,500. And if you are subject to that 3.8% surtax, if you have your income is over roughly $250,000 for a particular year, you know that there's a 3.8% surtax on any net investment income. That would include capital gains. So if you were subject to that, you'd save an extra $342 in this example by giving appreciated property to charity. So a lot of people, they think cash is the way to make a gift to property. Think about appreciated property, because it's going to give you a better tax benefit than cash, because you won't have to pay any tax on the capital gain. A lot of people don't even think about giving appreciated property, but it's a very, very valuable source of a charitable gift. A couple of updates we got to be aware of. We had some new tax legislation. We had the CARES Act that was enacted in March of this year. We also had the Secure Act that was enacted at the end of last year. And that's made some changes to charitable giving. For example, we have, under the CARES Act, which was enacted in March, there is now a $300 deduction that is available even if you don't itemize your deductions. Usually for income tax purposes, if you want to take an income tax charitable deduction, you have to itemize your deductions. So you have to fill out Schedule A, put on your mortgage interest, your real estate taxes, your charitable deductions, etc. If you don't itemize traditionally, you wouldn't get any benefit of making a charitable contribution. But this year, you'll be able to make a gift up to $300 to a charitable organization. Even if you don't itemize, you'll be able to deduct that. It is a so-called above-the-line deduction, and that $300, according to the Internal Revenue Service, is the total you will get for the family unit. So if you and your spouse both give $300, you're limited to $300 above-the-line deduction. And as I mentioned earlier, the CARES Act also increases the amount of cash that you can give to a charity. That is the percentage limitation. You can give up to 100% of your adjusted gross income just for this year to a public charity like Radford and be able to deduct the entire amount. We'll talk about a little bit of detail of some planning opportunities that may provide. Under the Secure Act, I'm going to talk a little bit about these so-called qualified charitable distributions, which is a situation whereby you, if you're over 70 and a half, you can make a direct transfer out of an individual retirement account to Radford or any public charity, and that will not be considered a taxable distribution. We'll talk about how the Secure Act changed that a little bit. We'll flip over and talk about the 100% cash contributions that are deductible this year. As I mentioned earlier, traditionally the limit on cash contributions has been 50%. Government upped it to 60% at the end of 2017. But for 2020, as a result of the new legislation, for this year only, you can deduct up to 100% of the cash that you contribute to a public charity. Got to be cash. You don't get the 100% of AGI limitation for gift of appreciated property like stocks or real estate. It's got to be made to a public charity, and Radford is a public charity as an educational institution. And any excess that you make over 100% of your income, you can carry over for 5 years. I don't think there's going to be too many people that are going to be making contributions of over 100% of their AGI. But the important point here is if you want to take advantage of this, you have to elect it on your income tax return. If you don't make the election in your income tax return, the 60% of AGI limitation applies. Now, how might this be beneficial? Here's an example. Let's suppose I have money in an individual retirement account. And I know that if I take money out of my individual retirement account, that is going to be taxable income to me. I will have to pay income tax on that. In a lot of cases, we have clients that don't really need distributions from their IRA because they got plenty of other money, and they want to give the IRA to a charitable organization. Well, an IRA given to a charitable organization works really well if it's a gift at death. So you can name a charity as a beneficiary of your IRA or any qualified plan, and you won't have, your estate won't have to pay any income tax on that. And when the charity pulls that money out of the IRA, since they're tax exempt, they don't have to pay any income tax. But that's only if the IRA is left to the charity at death. How can we make a charitable contribution and get a tax benefit, make a charitable contribution from an IRA and get a tax benefit during lifetime? Well, here's what you can do. Now that we have this 100% of AGI limitation, let's say I have no income whatsoever. The only income I have is what I take out of my individual retirement account. Let's say I take $100,000 out of my IRA. That's $100,000 taxable income to me when I take that out of my IRA. Well, traditionally, we could only get a charitable deduction for 50% of that adjusted gross income we have of $100,000. So we'd only be able to deduct $50,000. And still, even though we gave that whole amount, that whole $100,000 to Radford, we'd have to pay tax on the other $50,000. Well, this year, because you've got this 100% of AGI limitation, what you could do is take a distribution from your IRA and contribute the whole IRA to charity and get an income tax charitable deduction, which would offset that taxable income from the distribution from the IRA. Now that's going to work for federal purposes. You got to be careful about your particular state, because your state may be like my state of Massachusetts, which does not give an income tax charitable deduction on the state return. So while this might work for federal purposes, we might have a little bit of a problem with state. We might end up paying state income taxes depending upon what our state law is. So we can take money out of our IRA. The other thing we could do is, if we have an IRA and we'd like to convert that traditional IRA to a Roth IRA, we know that when we convert a traditional IRA to a Roth IRA, that results in taxable income. Well, what could we do? We could convert our individual IRA to a Roth IRA, turn around and give the same amount a contribution to Radford or any public charity, and we can use that charitable deduction to offset the taxable income that's going to result as a result of the Roth conversion, converting our traditional IRA to a Roth IRA. Now, I've got an example that deals with a lot of money. Don't get psyched out by the amount of money that is up on the screen here. This is just to illustrate the fact that you can do a Roth conversion. You have to recognize that income, but you can offset that income by taking advantage of the 100% of AGI limitation that's only available for this year, for 2020. Everything else stays the same. If we make a contribution to charity of cash, and we don't elect the 100% of AGI limitation, the limitation is 60% of our adjusted gross income, and the 30% of AGI limitation for long-term capital gain property still applies. Nothing else has changed. There's just a beneficial $300 you can give this year, and the 100% of AGI limitation that you can give this year. And I just want to mention one thing before we get to this. One of the problems that people may have is, as a result of the Tax Cuts and Jobs Act that was enacted in 2017, the government has basically doubled the standard deduction for individual taxpayers. So for example, it used to be that your standard deduction was roughly $12,000. Now it's double that. It's about $24,000 for people married filing joint. So that means that if my standard deduction is $24,000, unless I have itemized deductions, my mortgage interest, my real estate and state income taxes, and my charitable deductions and my medical expenses, unless all of those added up together exceed $24,000, it doesn't really make any sense for me to itemize my deductions. And we know that we can only take a charitable deduction if we itemize our deductions. So it may be that a lot of people are going to be better off taking the standard deduction than they are in itemizing their deductions, because they just don't have enough itemized deductions to exceed the $24,000. So what do? What you might do is bunch the deductions, the charitable deductions, in 1 year. So maybe this year I make a very large charitable deduction, either outright to a charity or to a donor advised fund, which we'll talk about in just a sec. And then I make a large enough deduction, so with that contribution plus my other itemized deductions like my real estate taxes and my mortgage interest, I'm over the $24,000. Then the next year, I'm below the $24,000 I itemize. So maybe what I want to do is play the game and bunching the charitable deductions in 1 year so I can get above that $24,000 limitation and itemize that deduction. This is a very charitable, this is a very favorable type of technique that a lot of people use. It was provided for in the tax law in 2006. It is now permanent. Here's how this works, this IRA charitable rollover. If I am over 70.5 years old and I have an IRA, I can make a direct transfer from my IRA to a public charity like Radford. Normally that would be a taxable distribution, but if I'm over 70 years old and I make the direct transfer from the IRA custodian to Radford University, That's called a qualified charitable distribution that is excluded from my income. So it's a freebie, it's tax-free. So if I'm over 70 and a half, I can get up to $100,000 out of my IRA over to Radford without having that included in my income for income tax purposes. And that's $100,000 per taxpayer per year. So if husband and wife both have IRAs, they could each do up to $100,000. We have clients that do this every single year, not necessarily the full $100,000, but some portion of their IRA gets excluded from their income. It's only an IRA. You can't do this by taking money from your 401k, your 403b plan, et cetera. What you could do with your 401k is roll the 401k into an IRA and then make the contribution from the individual retirement account to Radford. But it's only an individual retirement account that qualifies. And one of the things you have to be aware of is it can't be a situation where you take a check and then cash the check and give the proceeds to Radford or a public charity. It's got to be a direct trustee to trustee transfer. Generally speaking, you can't put your hands on the money. Now, what could happen is that the custodian could write the check payable to Radford, give the check to you, and you turn it over to Radford. That's fine. That's fine. But if it's made out to you, you cash the check. This is not going to work. So just be careful to do a trustee to trustee transfer so you don't fall through the cracks on this. And like I said, a lot of people use this every single year. Now, there have been one change that you got to be aware of that was made as a result of the Secure Act. And here's what that is. Traditionally, people, once they hit 70 and a half, could not make a tax-deductible contribution to an individual retirement account. So once you hit 70 and a half, you can't push any more money into your IRA and take a tax deduction for that. Well, they eliminated that rule under Secure. So if you're over 70 and a half, you could be, I guess, 85 and still be making tax-deductible contributions to your IRA. What they did under the Secure Act is if you do that, if you're over 70 and a half, and you make a tax-deductible contribution to your IRA, and you elect this IRA charitable rollover, you have to reduce the amount of the so-called qualified charitable distribution that qualifies for the exclusion by the amount of the tax-deductible contributions that you made to the individual retirement account after you were age 70 and a half. So let's say I'm over 70 and a half, and I've made tax-deductible contributions to my individual retirement account for this year, next year, and 2022. And then in 2023, I decide that I'm going to take $30,000 and directly transfer that to Radford out of my individual retirement account. What I have to do is I have to reduce that $30,000 by the tax-deductible IRA contributions I made in 2020, 2021, and 2022. So just be aware of that. If you do make tax-deductible contributions to your IRA, that is going to reduce the amount that's going to qualify for this so-called IRA tax-free rollover. Another valuable technique that is relatively simple is a charitable gift annuity. What this basically is it is kind of like a part charitable gift and a part sale to the charity. What you are doing with a charitable gift annuity is you go to Radford and you say, you know, I'd like to give some money to Radford University, but I'd like a stream of income back. And so what they're going to do is they're going to structure a charitable gift annuity for you. So you either give Radford cash or you give them property like long-term capital gain property, stock that you've held for over a year. And in return, you will execute with Radford probably like a 2-page contract that says, okay, you're going to give us the cash or the property, and in return, what we're going to do is we're going to give you an annuity for your life or for the life of you and your spouse, let's say, for example. You'll get an annuity every single year from the charitable organization. And in addition, what will happen is after your term runs out, when you die, whatever is left of that property will go to Radford. So since a so-called remainder interest in that annuity is eventually going to go to the charity, you will get an income tax charitable deduction, whatever the value of that remainder interest is when you set this up. So what you're getting is you're basically giving property to a charitable organization. You're getting a stream of payments back for your lifetime. You get an income tax charitable deduction for the amount that the value of that remainder interest. And this is a simple way to give money to charity and still get a stream of income back. And it's simply a contract. This 2-page contract that basically says we're going to give the money to Radford University. They're going to give us a stream of payments back for our life or life expectancy. So the question you probably have is, how much is my annuity? I'm going to flip through a number of slides here. I'm going to go back to a table to show you what the annuity rates are. Here they are. If you are age 65, and these rates basically not negotiable. If you go to Boston University here in Boston, you go to Massachusetts General Hospital here in Boston, you go to UCLA, you're going to get the same rate, the uniform rates. So if you're age 65 and it's going to go over your life, you will get a 4.2% payout from that annuity. So if you give them $100,000, you get 4.2% back. If you and your spouse are both age 65, it's 3.8%. So you can see the table. On the left-hand side deals with an annuity that's payable life. On the other side, the right-hand side of the table, that is for 2 lives, both of whom are the same age. There's tables that show you what happens if you're 65 and the other spouse is 66, 67, 80, whatever. They're just too numerous to put in this table. This is a sample to show you what those rates would be. So this is a very easy way to make a charitable gift to an organization and take advantage of the stream that comes back in the form of payments, and also the amount of the income tax charitable deduction that you will get. Here are the benefits. Basically, what will happen is if you give appreciated property, you can have the recognition of that gain every time you get a distribution. Part of that gain will be ordinary income, part will be capital gain, and part will be a return of principal, non-taxable. So you could defer the capital gains tax on a contribution of appreciated property. Like I said, you get an income tax charitable deduction, you'll get a stream of payments for life. And this, while it may sound a little bit complicated, it is extremely, extremely simple. There are other techniques that people can use that we're not going to talk about today that are a little bit more sophisticated. There are things like charitable remainder trust, whereby you set up an irrevocable trust, you give property to Radford, they sell it, there's no recognition of the capital gain, you get a stream of payments back. It's the big brother of a charitable gift annuity. You can also make a bargain sale to a charitable organization like Radford. You have an asset, you sell that asset to Radford for less than the fair market value. Let's say you sell it to Radford for, it's worth $100,000 and you sell it to Radford for $60,000. You get an income tax charitable deduction for the $40,000 differential. So there are a number of other charitable giving techniques that are available. And unfortunately, we don't have enough time today to go through all of those. So if, Frank, if you want to open it up, you have questions that have come in, or you can think of things you want to discuss, we can talk about those other items now.
I actually don't have any questions that have come up yet. If somebody has a question, feel free to type it in the chat box. Oh, wait, just kidding. I see one. Someone asked how you leave Radford in your will.
I see that. You guys want to talk about that? You may have procedures.
We do, and it's outlined. I have a planned giving brochure guide that we would be glad to send anybody today. We have sample language in here, detailed sheets on exactly how to do that. And they can reach out directly to me at tlillard@radford.edu, and I'd be glad to send these out.
One of the things that I should mention is if somebody wants to leave an individual retirement account, a 401k plan, or any type of deferred compensation to Radford, the best way to do that is at death, because that's going to give you the best tax advantage. And if you do that, you'd want to name Radford directly in the beneficiary designation form. A lot of people try to get cute and leave the IRA to their estate or to a trust, and then have the estate of the trust leave an amount to charity. Well, that could cause a lot of complications in having that distribution from the trust of the estate to the charitable organization qualify for an income tax charitable deduction. There's a lot of hoops you have to jump through, and I can tell you there's a lot of attorneys that screw this up because it's a little bit difficult to handle. Like I said, if you're thinking about doing something like that, bypass the estate, bypass the trust, and name the charitable organization like Radford directly on the beneficiary designation form. When you pass away, the charity will get that money. You won't have to pay any income tax on the money in the IRA. And when Radford pulls the money out of the IRA, since they're a tax-exempt entity, they won't have to pay any income tax on the IRA as well. We see a lot of charitable gifts of individual retirement accounts ranging from $20,000 to $50,000 into the millions of dollars because it's a great technique for charitable giving.
Awesome. I think that we answered that question. So, like you said, if you have any questions from this point moving forward, feel free to reach out to Tom Lloyd. We just did get another question. What should you look for or avoid in an attorney when you're trying to set up a trust?
I'm going to let you have that one, Jerry.
Find somebody who does this on a regular basis. Trust and estate attorneys. There is a group called ACTEC, ACTEC, American College of Trust and Estate Counsel. If they're a fellow of ACTEC, they're top notch. But what I would do is I would look for somebody who does this all the time. You probably will run into a problem if you have somebody that is a general practitioner, does a real estate closing one day, a divorce the next day, litigation the next day, and you go to him and he tries to write a trust document. You want somebody that specializes. Like you go to the hospital, you want a person that specializes in the surgery you're trying to, that you want to have performed. Same thing with an attorney.
And I will say we have had some attorneys that have done multiple estate gifts with us, and I would be glad to discuss that privately.
How do you designate what university program you want to support? Usually you can specify what program in the university you want to benefit in your document. You just specify that as opposed to having it go for general charitable purposes. You want to talk about how you guys handle that?
We have a one-page form that is basically a simple gift agreement, so it would be noted exact designation where we would like to place it.
How about beneficiary of a life insurance policy? Simply name the charitable organization as the beneficiary of the policy. You won't get an income tax charitable deduction when you name the charity as the beneficiary of an insurance policy, but it will be excluded or will be deductible for federal estate tax purposes when the charity is named as a beneficiary. And I don't see any others unless you guys have something you wanted to follow up on, something I talked about or questions.
Jerry, I'd like to thank you for the great presentation, and I'd also like to thank all our partners at BNY Mellon. You guys have been a tremendous asset. You may want to give out your email again, if that's okay, and I'll do the same from my end.
Yep. Here's mine, JERE.DOYLE@BNYMELLON.com. Feel free to email me if you got a question. Be more than happy to answer it.
And mine is tlillard, Lillard, @radford.edu. Again, I'd like to thank everybody for joining us today. I think it was a great presentation. And Jerry, again, thank you for your wonderful assistance.
Thank you, guys.
Okay.
Thanks, everybody.
Thank you.